The truth about AI in investing. Artificial intelligence, AI, has become one of the most talked about innovations in the financial world. From stock market predictions to portfolio management, AI is often seen as a revolutionary tool that promises to change the way people invest. Some believe it can outperform human advisors, while others remain skeptical, pointing to risks, biases, and overhyped expectations. The truth about AI in investing lies somewhere between these extremes. It's a powerful technology, but not a flawless one. The rise of AI in finance. Over the last decade, AI has quietly moved from being a futuristic idea to a real tool in the investment space. Hedge funds, banks, and fintech startups use machine learning models to analyze massive amounts of data, spotting patterns no human could ever detect in time. AI-powered robo-advisors now help everyday investors create personalized portfolios with little more than a few clicks. What makes AI so attractive is its speed and scale. A human analyst might spend days researching a single company, but AI can digest thousands of financial reports, market signals, and economic indicators within seconds. This ability to handle big data has made AI an indispensable part of modern finance, especially in high-frequency trading, risk analysis, and wealth management. What AI can actually do. One of the key truths about AI in investing is its versatility. At its core, AI can analyze market trends. Machine learning algorithms are trained on historical price data to identify potential movements. Automate trading. AI-driven trading bots can execute trades in fractions of a second, reacting to market changes instantly. Manage risk. AI tools can flag risky investments by analyzing volatility, credit ratings, and company fundamentals. Personalize advice. Robo-advisors use algorithms to tailor portfolios to an individual's risk tolerance, time horizon, and financial goals. Detect fraud. Financial institutions also use AI to spot unusual activity, protecting investors and clients from scams. These capabilities have made AI a trusted assistant in the financial world. However, understanding what AI cannot do is equally important. The limitations of AI in investing. Despite the hype, AI is not a crystal ball. It cannot predict the future with perfect accuracy. Stock markets are influenced by unpredictable events, political upheavals, natural disasters, and new regulations that no machine can fully anticipate. AI models also depend heavily on the data they are trained on. If that data is biased, incomplete, or outdated, the results will be flawed. For example, an AI trained on a decade of bullish market data may struggle to adapt to a sudden recession. Another limitation is overfitting, a common problem in machine learning where a model becomes too finely tuned to past data and fails when confronted with new, real-world scenarios. In investing, this could mean an algorithm works brilliantly in simulations but falls apart in live trading. Human versus AI in decision-making. Some argue that AI will eventually replace human financial advisors and traders. While AI is indeed faster and more data-driven, humans bring intuition, judgment, and emotional intelligence to the table. Markets are not purely mathematical. They are influenced by investor psychology, news narratives, and even social media trends. AI struggles to interpret these human-driven factors in a meaningful way. For example, while AI can scan millions of tweets about a company, it cannot fully grasp sarcasm, cultural nuances, or shifting public sentiment. Human advisors, on the other hand, can combine hard data with soft factors to make more balanced decisions. The reality is that the future of investing will likely be a collaboration between humans and AI. Machines will handle data-heavy tasks, while humans provide strategic oversight and ethical judgment. The risks of relying too much on AI. Over-reliance on AI can be dangerous. Flash crashes in the stock market, sudden, dramatic drops triggered by algorithmic trading, highlight the risks of automated systems acting without human checks. If too many investors rely on similar AI strategies, markets could become more volatile and less predictable. There is also the issue of transparency. Many AI models are black boxes, meaning even their creators cannot fully explain how they arrive at certain conclusions. This lack of clarity makes it difficult for investors to trust AI blindly, especially when large sums of money are at stake. Cybersecurity is another concern. As financial systems grow more dependent on AI, hackers may target algorithms to manipulate trading behaviors or exploit weaknesses. A single breach could ripple across markets worldwide. Opportunities for everyday investors. For retail investors, AI offers exciting opportunities. Affordable robo-advisors have made professional-grade portfolio management accessible to millions of people. AI-driven apps can help investors track spending, forecast returns, and even suggest ways to diversify. These tools don't guarantee overnight wealth, but they do democratize access to strategies that were once reserved for Wall Street elites. With AI, an ordinary investor can benefit from data-driven insights at a fraction of the cost of a human advisor. However, everyday investors must approach these tools with realistic expectations. AI is an assistant, not a fortune teller. The most successful investors will use AI to complement their strategies rather than replace them entirely. The balanced truth. The truth about AI in investing is that it is neither a miracle solution nor a dangerous gimmick. It is a tool, powerful when used wisely, risky when relied on blindly. AI works best when combined with human judgment, offering investors deeper insights without replacing critical thinking. As technology evolves, we can expect AI to play a bigger role in everything from stock trading to retirement planning. But investors should remember that markets will always involve uncertainty, and no algorithm can eliminate risk. Artificial intelligence is reshaping the investment world, making markets faster, more data-driven, and more accessible. But the truth is, AI is not a replacement for human wisdom, it's a complement. Investors who approach AI with realistic expectations, balancing machine insights with human judgment, stand to benefit the most. As you think about your own financial journey, consider using AI tools to guide your decisions, but don't abandon the timeless principles of patience, discipline, and diversification. In the end, investing will always be part science, part art, and AI is simply the newest brush in the toolkit. And that wraps up our deep dive into the truth about AI in investing. While artificial intelligence is changing the way we manage money, it's not a magic formula. It's a tool that works best when combined with human judgment and smart decision-making. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss our latest content. Drop your thoughts in the comments below. Do you think AI will completely take over investing, or will humans always have the final say? Thanks for watching, and I'll see you in the next video.